I hate standing behind a podium. All right, so the paper is co-authored with Aris Reyes and Stephen Chung, and yeah, it's on. Actually, these have presented, I think, now 3 papers here, and Stephen and Aris have been my co-authors on most of them, because most of them are Chinese-related papers, and I write a lot with them when I write about China. Now, what is this paper about? The basic question is very straightforward. There's a huge array of evidence that if you're a controlling shareholder, you tunnel resources away from your minority companies, where a whole bunch of minority shareholders exist, and you tunnel resources away from them for your own private benefits. And I'm not going to go over that literature in detail. One of them is my own paper over there in 2006, but there's a gigantic stream of literature there. The question which this one doesn't answer is that when does this happen? Right? We don't know when it happens, and we don't know why the controlling shareholders engage in tunneling activity. Now, this is more specifically, the question we are looking at is, what are the incentives of the controlling shareholder to expropriate the minority shareholders? Now, there is no direct evidence in the literature at the micro level. Right? Everything is at the macro level. So we look at, for example, papers that look at the Southeast Asian crisis, we look at business groups, we look at the financial position of a publicly listed firm, but everything here considers the controlling shareholder as a black box. These guys are expropriating, and we know that, we just don't know when, and we don't know why they're doing it. Now, so why should we care about it? Well, there are 2 possibilities. One is, it's kind of like a tax. It doesn't matter what state of the world is, you're losing 10% of your money to your controlling shareholder in every state of the world. That's one possibility. Second one, only some states of the world in which the controlling shareholder chooses to expropriate. Right? So maybe he expropriates only when he's in financial distress. Maybe he props you up when he is having a lot of money. So these are very different scenarios. And if you want to try to control, as a minority shareholder, you're deciding, am I going to buy shares in this particular firm, knowing that the controlling shareholder might expropriate or might not expropriate? I would need different corporate governance mechanisms to decide which is the optimal way to control this, right? As opposed to a general tax across all states of the world, only particular states of the world which the guy is choosing to expropriate. So that's the question here. But if you don't know when he's doing it, you don't know what kind of corporate governance rule to put in place. All right. So why doesn't prior literature answer this question? And the answer is pretty straightforward. It's because we don't have the data. Right? And the reason we don't have the data is usually the controlling shareholder is a person. So, and it's very tough to go to most, countries like China or even India and then say, hey, how much money do you have? How much, what's your financial position? Is it going down? You can't do this. Fortunately, in China, most of the controlling shareholders are actually other companies. They're non-listed, they're private companies, but they're state-owned, and you can get data on their operating performance. Right? That's the key part here. So our hypothesis is, if you're underperforming in relation to operating performance, you have a higher incentive to expropriate and tunnel resources out of your publicly listed subsidiary. Right? But one question, of course, is, look, you're not listed. There's no shareholders to deal with. So why on earth would you say, I care about the performance? I mean, I'm working for the government, right? No biggie. Well, it turns out in China it's really important. You don't actually get money. You don't get a big bonus if your company does well. So there are no direct pecuniary benefits, but there's a whole bunch of indirect benefits. You get political promotion and so on, which are all listed to that operating performance of the non-listed firms you manage. So they are concerned with their performance, and that's important. So what we do is we look at this non-consolidated financial information for the controlling shareholders, and that has financial statement information for all industrial firms, whether they're listed or non-listed. And we look at, the key is, we look at the magnitude of the expropriation of the minority shareholders for the listed firm as a function of the operating performance of the non-listed controlling shareholder. That's pretty much the entire paper. When we talk about operating performance, we're looking at ROA, or cash flow to asset ratio, and that's it. So that's pretty much it. Right? And we have 2 proxies to expropriation. First is the direct evidence. So direct evidence is we're looking at a loan made from the subsidiary to the parent, right? The public listed subsidiary to the parent. And then we look at how those intra-group loans are actually valued by the market. And then we look at indirect evidence. It's broader because, and this is just the value of cash on the balance sheet of the listed firm. Now, the second one is obviously you can use cash for a whole bunch of other reasons, not just giving loans to your parents. So it's kind of indirect. But it's a bigger sample. So we have both types of evidence in the paper. Okay, so what are the direct flows? The question is, how much money do you actually lend your parent, and does it depend on the performance of the parent? How does the stock market value that intra-group loan? And that measures the ex-ante likelihood that investors are placing on the fact that the loan is never going to be repaid. You're just making a loan to your parent, it's never going to happen. So if you, for example, make $1 of loans, and it's valued on the balance sheet as 0.5, you're basically saying there's a 50% probability I'm going to be repaid. And we are using the same methodology to value both intra-group loans as well as cash holdings. The standard methodology, the Fonkinder and Wang methodology value cash holding, we just apply that to intra-group loans. All right, the indirect evidence, same thing, but we're looking directly at the cash holdings, and that's again the cash holdings being appropriated. And it comes back to a bunch of other papers which talk about the fact that if you want to steal something, it's much easier to steal cash than to steal a big factory or something, right? And so the value of the cash is most likely to be sensitive to the likelihood of expropriation, and there are lots of good models for estimating the value of those cash holdings. Okay, so this is the example which summarizes the whole thing. You've got a subsidiary, it's publicly listed. You've got a parent, which is non-listed parent, and it's controlling. We know the operating performance of the parent is. We know what the value of the cash and the intra-group loans for the subsidiary are. And the idea is, if the investor knows ahead of time, okay, I'm buying shares in a firm where this value is likely to be expropriated, I'm going to value the assets on the firm of the subsidiary much lower than if I think it's never going to be stolen. Okay. All right, what do we do? Well, one of the things we do not do is we don't document there is expropriation. I mean, that's been done a million times before, so we don't really care. What we are showing is the timing. That's basically when and why. All right, well, data sources, standard stuff. It comes as we have 488 firms for a period of 10 years, and they're non-listed controlling shareholders. That's about 2,209 paired firm year observations, listed firms and their parents. And we ended in 2007 because 2008 was a financial crisis. So what's going to happen is the value of cash is going to drop on the balance sheet of all the firms. It's very difficult to pull out, okay, this is expropriation versus this was a financial crisis. China didn't actually have a financial crisis, but they pumped in so much cash into the economy, it contaminated a whole bunch of different things over there. That's why we stopped in 2007. And the data comes from the CSMAR database. All right, so what does the regression look like? So what we have is the intra-group loan there. That's other receivables. And we are regressing it on the listed firm cash balance. Right? So this is other receivable extended from the public listed shareholder to its controlling parent as a function of the listed firm cash balance there. The change in the listed firm cash balance. We are looking at other factors identified in Jiang, Li, and Wu, who also look at the value of intra-group loans. So ROA, the marketization index, the ownership of the largest shareholder, and so on. And most important for us, the new stuff which we have, is we are linking it to the value of the parent ROA and interaction between the parent ROA and the listed firm cash balance. Okay? So those are the factors we're going to focus on. The remaining stuff is pretty much values from prior literature. Okay. So what does the results look like? And what you're going to see here is exactly what we expect, right? Your parent ROA is doing better. The value is the change, this number here, is negatively related to the value over here. So in other words, what you're having is the parent is doing worse. The value on your cash balance sheet is going to show up, the amount of loans you're making is going to go up when the parent is going worse, right? And exactly the same thing here. So regardless of what else you control for, these two are consistently significant. So that's our baseline specification, which doesn't have those as well. And to put this into economic context, the idea is if you are in the bottom 25% quartile, if your parent really does one of the worst quartiles over there, it increases intra-group loans by about 4 cents, which is pretty straightforward. You got 0.024, the value of the cash balance here. 14.1% is the average from across all firms in there, plus 0.0024 times minus 0.017, which is the parent ROA there, and so on. So you just get that value. That's about, it's about increasing by about 4 cents per year. Okay? But on the other hand, if you're performing the top one, it turns out it increases by less than 2 cents. So there's about a 50% increase if your parent is performing worse than if your parent is performing better. Okay. Now, one of the questions which I'm typically asked when I do present this paper is, this is just a business group phenomenon. So essentially what's happening here is, all these firms are in a business group, they insure each other. One of them does badly, the other will step in and help it out. Not that big a deal. Not really the case here. The reason is because in a traditional view of a business group, as a minority shareholder, I can protect myself, right? I just buy shares, all the other firms in the business group. So regardless of what's happening, I can protect myself because one firm is being benefited, fine. I'm owning shares in the firm which is being benefited. I'm owning shares in the shares which is being hurt. So overall, I'm completely unaffected by this. I can't do this in China. I can't protect myself because I cannot buy shares in the state-owned firm. So if I'm buying shares, I'm only buying shares in the subsidiary. And unfortunately, so as a minority shareholder in a publicly listed firm, it's expropriation, regardless of what is happening anywhere else, right? And most business groups in China, it turns out they control only a single publicly listed firm. Less than 4% of the publicly listed firms in our sample share common controlling shareholders. So you got one group, entire thing is basically all private firms, and you got one publicly listed firm at the bottom. And there's no way for the shareholder in that firm to protect himself. So how do you the market value this? So the first one was how many loans, what amount of money do you lend your parent? And we saw that was negatively related to the performance. The worse the parent was doing, the more loans you extended. The next question is, you can't protect yourself, so as a minority shareholder, how do you value the loans on the balance sheet? And this is directly taken from Faulkner and Wang, 2006. So complicated regression, that's the excess returns to the Carhart four-factor model. And these are the previous numbers. All these ones are standard variables taken from the Faulkner and Wang model. The ones we care about are these additional variables over here, right? And what we are saying here is this is the parent ROA, the change in the other receivables you're giving your parent, standardized by the market value of the publicly listed subsidiary. So we want to look at that sign of that coefficient over there. Okay, big bunch of numbers. What we're going to look at is this number here. And again, positive and significant across the board. What that's basically saying is, as your parent is doing better, the subsidiary's value of other receivables on that balance sheet goes up. So parent is doing worse, the minority shareholders say, great, I'm going to be expropriated. The value of the other receivables on the balance sheet goes down. Right? And it's consistent across, regardless of what else you control for. Okay, economically, what this is basically saying is, if you put the same values in there, if you're performing in the top quartile, that means you really your parent, your state-owned parent is really performing well. One additional dollar of intergroup loans is valued at 24 cents. What that's essentially saying is 76% you're not going to get back. Right? However, for the average Chinese listed firm with average performance, an additional dollar is worth only 5 cents. This is the top quartile. This is the average, right? So for the average firm, it basically says your other receivables is completely, moment you give any money to your parent, you're not going to get it back. But one possibility is it's just a mechanical correlation. Why is it a mechanical correlation? Because what's going on is the operating performance of the subsidiary is correlated with the performance, and it's in one economy. Maybe everybody in the economy is doing badly, right? Nothing to do with it. So what we have in the regression, though, are all a whole bunch of controls for the performance of that subsidiary itself. And those are significant. But even after controlling for those individual variables, adding the parent ROA has incremental explanatory power, right? And it improves the R squared, the adjusted R squared, and it does not affect the magnitude of the subsidiary's performance proxies. So we're saying that it's not just a mechanical correlation, there is additional value being created by the parent ROA there. And it's not really sure, because we control for actual dividend payments, why would the parent ROA would have that explanatory power unless there's some other non-dividend related transfer, and that's exactly what we hypothesize over here. Okay, so that was all the indirect evidence. The direct evidence is, as I said, first we have talked about intragroup parent. Now, what we are now going to look at is, this is the direct evidence. We're now going to look at indirect evidence. Indirect evidence is basically saying, well, it's not just, intragroup loans just one channel, but there are millions of channels. You can do related party transactions. You can buy assets from them at below a market value. You can sell assets to them at above market value. You can transfer money back and forth in many more ways than just intragroup loans. So intragroup loans are direct evidence, but not enough. So but we don't have data. We don't have data to say the related party transactions are that much accuracy as intragroup loans. So what do? We just look at the value of cash holding. So cash is kind of like a catch-all proxy, which proxies for all possible intragroup transfers, right? So disadvantage, of course, is just an indirect proxy. It's not direct. Okay. First thing, same one. It is basically how much money do you actually hold. Right? Second is how does the market value that money. So exactly the same as before. The dependent variable is a natural log of 1 plus the ratio of cash to the total net assets of the entire firm there. And our coefficient of interest, just like before, is the parent ROA. Okay. What do we find? As the parent ROA goes up, you hold more cash on your subsidiary, right? Which is kind of interesting to start with. I mean, if the parent ROA goes down, you hold your cash holdings in a subsidiary go down as well. This is actually related to a bunch of other papers, like for example, Mara Fascio and John McConnell have a paper which talks about how do you shelter your assets from political expropriation. And the idea is whenever a political party gets more and more power, you reduce the amount of cash on your balance sheet because you know it's going to get stolen. So you convert your cash into something that can't be stolen quite as easily. And that's exactly what we are finding here too. Okay. Then we say, what's the value of that cash? Again, the same type of model. So excess returns relative to the Carhart 4-factor model. But our variable of interest, again, is just as before, the parent ROA times the change in the amount of cash you're holding. Okay, what do the numbers there look like? Exactly as the other, as with the other receivables. And what we find over here is, again, significance across the board, across all the variables we look at. So for example, the parent ROA here is basically higher. That means the value of cash on the subsidiary's balance sheet is also higher. Okay? And I'll walk you through some of the other regressions in a bit. But that's the major takeaway for this point right here. So same results whether you're looking at direct intragroup loan or whether you're looking at indirect evidence through cash balances. Okay, economic interpretation. What's the marginal value for a dollar of cash on your balance sheet? Turns out if you're in the bottom quartile, the marginal value of cash is 47 cents. If you're in the top quartile, it's 66 cents. That's about 50% increase. Okay. it's what happens if the controlling shareholder is a state-owned enterprise? Well, you can look at some cases when the controlling shareholder is not a state-owned enterprise. It turns out the difference in the margin value of cash is about 24 cents. Okay. Does the type of SOE matter? Again, the answer is yes. If the firm is controlled by the central government, the value of cash is about 86 cents. The central government doesn't steal that much money. If it's controlled by a local government, it's 64 cents. Right? So, and in a previous paper, we showed that the farther away you are from Beijing, the lower is the value. We don't do that analysis here, but I think that's probably going to be consistent with what we find. Okay, another alternative explanation is basically, well, hold on a minute. One of the things that's going on is maybe just poor corporate governance. It's not really parents stealing the money. It's because the poor underperforming parent firms are underperforming because they have bad corporate governance. So what's happening is here is your parent isn't doing anything. Right? The parent can't manage the subsidiary very well. So maybe the subsidiary manager is just stealing the money themselves. It's not going up the chain. It's just because the parent isn't controlling you well. We replicate all our results after including controls for corporate governance. The results don't change. And then we look at samples where there are no changes in any performance over the sample period. So we're only looking at a subsample of firms with big changes in performance, right? And no changes in corporate governance. So corporate governance hasn't changed, but performance has changed dramatically for the parent firms over that period. And we find big changes in the value of cash. So if your performance goes up, your value of cash on your balance sheet of the subsidiary goes up. If the performance of the parent goes down, value of the cash on the subsidiary goes down. There are no changes in corporate governance, so this cannot be a corporate governance story. A second alternative explanation is coinsurance. Coinsurance basically says very straightforwardly, well, you know, it's just a propping ability, right? In some cases, what's going to happen is it's not going to show transfers. It's basically an implicit guarantee of assistance you're going to get. If your parent is doing well, it can support you, right? If you're going to do badly as a subsidiary, your parent is doing well, it will support you. But when the parent is not performing badly, it can't assist the subsidiary. So what the market is saying is, look, I'm expecting my parent to help me, but you know, the parent is doing well, yes it can, so it values the cash high. Parent is not doing well, so the parent can't help you, so the value of cash is low. Right? So there's no transfer. Okay, so there's no actual transfer, it's just the ability of the parent to help. Well, if that was the case, if it was coinsurance, the propping up would be much more plausible in small public listed subsidiaries who are likely to be financially constrained. Right? It's also more possible when the subsidiary is small and earns a smaller profit from its parent. That's when you can help them. So what we look at is, look at large firms that don't face financing constraints. It turns out there is a significant relation of parent performance and the level of cash holding. But you don't find any relationship between small and financial constrained firms. So in other words, your subsidiary is small. That's precisely when the ability to help will be the largest. But that's why you don't find a relationship. You only find it when the subsidiary is big compared to the parent, where the parent cannot help you if you get into trouble, but the parent can siphon cash away. Okay. So, and the larger the losses the subsidiary is, interestingly, the larger the loss the subsidiary is making relative to the parent, the higher is the market valuation of cash on the subsidiary's balance sheet. So what's happening is, basically the subsidiary is making so many losses, the parent is unable to siphon cash out, and the market values the cash on the balance sheet higher. Okay, overall conclusions. Basically, so far all the papers have been focusing on the controlling shareholder as a black box. What we saw in this paper is we're linking the extent of expropriation of the minority shareholder of a public listed firm to the performance of the controlling shareholder. And our findings are basically meant to help us understand under what circumstances do you get expropriated. And in this particular case, it appears that the performance of the controlling shareholder is a significant determinant of when your money gets expropriated as a minority shareholder in a publicly listed firm. Okay.
All right. So first, thanks, Susan, for asking me to discuss this paper. I was very happy to have to read the paper. I learned a lot from reading the paper. well, this is one of the advantages of coming to conferences and discussing. You get to read interesting papers which you otherwise might not read in all the detail. So what does this paper study? Well, they're trying to understand incentives driving expropriation by controlling shareholders. Right? And the basic question is, when do controlling shareholders engage in tunneling activity? When do they take money out of the firm that they're controlling? And the usual problem that why others have not been able to answer this is they don't have any information about the controlling shareholder. And this paper looks in the context of China, where the controlling shareholder is a firm, and therefore you can get a lot of information about the firm. Even though it's private, you do observe what's happening to the controlling firm. So that's the advantage in this case. So the main results of this paper, here's the punchline. The incentive to tunnel resources from the publicly listed subsidiary is higher when the parent is performing badly. Okay, so that's the main takeaway that I get from the paper, and they show it in many different ways, but here are the main results. So when the parent firm is performing badly, we see first, there are higher intragroup loans from the subsidiary to the parent. Second, there's a lower market valuation of the stock of intragroup loans that the subsidiary has when the parent is doing badly. And third, when the parent is doing badly, the cash, the liquid cash on the balance sheet of the subsidiary seems to be getting a lower market valuation. Okay? And there are other things that kind of support this. So why I like this paper? I think the question is really interesting and important, and the authors do a lot of things to support the main result. So I'm, on the whole, quite convinced about this particular result, that transfers from subsidiary to parent are much more likely when the parent is performing poorly. Okay. Now, most of my comments will focus on, so what do we make of this? So how should we interpret it? Okay. Except for this one thing. So the question that the paper wants to ask is, when do parents expropriate? And given the empirical work of the paper, I'm not sure whether it's able to answer this question clearly relative to the question, which parents expropriate? Okay, these are two different questions. And what do you have to do when you have to answer when do parents expropriate? The thought experiment is, for the same parent firm subsidiary, you want to see when are the transfers from the subsidiary to the parent higher when the parent is performing poorly. So the critical thing is, for the same parent firm subsidiary, you have to see these results. So basically in the regression, then you need something like a fixed effect. I mean, that's one cheap way of getting out of it. But to the extent that I could make, there was no fixed effects in the regressions. Okay. So to that extent, what could be happening is some of the identification could be, or a lot of the identification could possibly be coming from the cross section, meaning some parents always do badly, they always expropriate from their subsidiary. Some parents always have good performance, they never expropriate from their subsidiary, okay? Which is not answering the question, when do parents expropriate? Okay. So essentially, there is some analysis that the paper does which looks at parents that have large changes in performances and focus on that subsample, which helps a little bit. But here are some suggestions that could go a little bit farther in answering this question of when do parents expropriate. So instead of using just the level of performance, maybe you want to use the shock to the performance at the parent level, right? So relative to whatever it is its usual performance, when it's doing much worse or much better, maybe that is what you want to use, which is a different way of trying to do the, I mean, you can always do fixed effect regressions, but with limited data, if you have a lot of fixed effects, you might not get enough power. So this is sort of an alternative to doing that. Alternatively, what you could do is use shocks at the industry level of the parent firm and see whether that affects transfers from the subsidiary to the parent. Okay. So in that case, again, that would be kind of a more convincing evidence. When things are going really bad in the industry of the parent will be affected, and do you then see in those cases subsidiary transferring resources to the parent, which would also get around some other problems that might come around. Maybe there's something changing in the parent, maybe the parent has some manager changing, or maybe the local government had a change and therefore other things are going on. So all of this you can get around by looking at the industry level shock for the parent. Now, here is where I come to what do we make of the results. So When parents are doing badly, subsidiaries transfer resources to the parents. What do we make of this? This critically depends on what is this behavior capturing. Okay. Is this expropriation, or is this some sort of a quid pro quo arrangement? So in general, I think it matters what we learn from this paper. To understand what we learn from this paper, we have to understand this transfer of resources from subsidiary to parent. Is it just a one-sided arrangement? In which case we learn when do these controlling firms grab resources from their subsidiary. Or if these are quid pro quo arrangements, you help me today, I'll help you tomorrow when you need me, then we learn something completely different in terms of when do subsidiaries help their parents in these sorts of arrangements. Okay. So to answer this question, what I would have liked to see is there any evidence of the other side of the quid pro quo arrangement or not? For example, are subsidiaries supported when they are doing badly by the parent? Okay. So to the extent, and I'm not sure if data is available, but to the extent one can do this, one could try to switch what the paper is doing, switch parent and subsidiary. In the sense, when the subsidiary is doing badly, do you see any evidence of resource transfer from the parent to the subsidiary? Or are subsidiaries that help their parents, are they better at withstanding shocks to their industry? So when their industry is doing badly, maybe that is the time when they really need help, and although you don't see any direct evidence of transfers, just the evidence that these firms are able to withstand those shocks better might sort of be suggestive of some sort of a quid pro quo arrangement. Okay. Now, the other thing is, again coming back to the question, is this expropriation? So expropriation critically requires that the parent is forcing the subsidiary to transfer resources. Okay. So another way of thinking about it, if the subsidiary was left to itself, would it have made these transfers? Okay. So one way of thinking about it is, let's split the sample based on subsidiaries which seem to be more independent versus subsidiaries which have less of a say in what they do, and see whether there is any difference between the behavior that you see. So if you see that subsidiaries that are more independent, who should be able to decide for themselves whether they want to transfer resources to the parent or not, they also transfer resources to the parent in exactly the same times, then probably there is some sort of a good reason why they are doing it, perhaps in anticipation of getting help from the parent at some point in time in the future. But if you see this happening only in subsidiaries which don't have much of a say, parents force them to do it, then that's a different interpretation. Okay, so this again goes back to answering the question, the basic pattern that we are seeing here, is this expropriation or is this a quid pro quo arrangement, which is critical for understanding what do we make out of this. All right. Now the third question is, fine, there are transfers from subsidiary to parent. From a welfare perspective, what do we make of it? So there could be transfers from subsidiary to parent. Clearly the subsidiary shareholders at that point in time, they're losing. But this transfer from a welfare perspective could be value creating, or it could be value destroying. So this has very different policy implications. For example, let's say the parents, they take resources from their subsidiary when they have really good investment opportunities, but they don't have the cash. Okay? And the subsidiary doesn't have that opportunity. So from a welfare perspective, you do want to transfer cash from the subsidiary to the parent so that better investment opportunities can be taken. So from a policy perspective, why does it matter? Because if this is value creation, then what you want to do is you want to let this behavior go on, but you want to make sure that the shares of the subsidiary is fairly priced. So the subsidiary is providing insurance to the parent, you want to price that in, and then you let that be. But if this is value destruction, meaning if this transfer is dissipative, then you want to try and stop this. Okay. All right, so how do we get around this? Or what do we do? So the suggestion is you can split the sample based on the industry queue, which can capture investment opportunities of the parent versus the subsidiary, and see whether you see more of this happening where the parent industry queue is higher than subsidiary industry queue relative to the other way around. Right? And also you might want to see, does the performance of the parent improve significantly after a transfer from the subsidiary, which would also kind of go in that direction. So I have a couple of other comments which I'll discuss with the author in detail. I just want to make one last point. There is this paper on business groups in the Indian context by Radha, Gopal, and Viknanda and Amit Seru, What they look at is they study intra-group loans in the Indian context from low, this is a business group context. So some firms have low cash flow rights for the controlling shareholders, some firms have high cash flow right for the controlling shareholders, and they study whether there are transfers using intra-group loans from low cash flow right firms to high cash flow right firms. And in fact, they find results quite similar to this, and they do find when high cash flow right firms are doing badly, that is when you transfer the resources from low cash flow right firms to those firms through intra-group loans, which they are able to observe in the Indian context as well. So I see there is a parallel to this paper, although this context is different, and I do see business groups is different from the context this paper is looking at, but since this is not cited, and I think this is kind of a relevant paper, authors might consider citing this. All right, to conclude, I think the question is really interesting. Basically, the authors are trying to understand what are the incentives of controlling shareholders to move resources from the subsidiary in this context. And the empirical results for the point that the authors are making is quite convincing. The authors could do a little bit more in terms of what to make of it, in terms of policy implications and so forth. And so I really enjoyed the paper, and I recommend that you read it.
Thanks, Rick. I now open the discussion to the floor. Any comments? Yes. Can you please introduce yourself?
Any thoughts about firm size effect as well as the industry characteristics effect? Because some of the industries generate huge cash flows, not necessarily be turning into operating results.
No, but in this case, and that's something going back to Rick's first point as well, you're looking at pairs, right? So every firm is mapped with its own, mapped with its parent. So in most of the cases, they are going to be in the same industry anyway. Right? So I don't, we could put in industry fixed effects, but I don't think it's going to take away the results. Right? And actually, that actually leads me to one more point, which, if I can make it for Rick's comment.
Sure.
One of the major things we have to realize in this paper is it's not at all like a business group transfer, right? One of the things which for example, here's the key part here. If I'm a shareholder in a publicly listed firm, I don't care about whether society is being benefited. I want my money back, right? Now, I can't protect myself if my controlling shareholder is, maybe my controlling shareholder has better investment opportunities. Maybe it's good for society for transferring money from me to there. But why do I care? I don't care. I want my money back. I can't hold any shares in the parent. It's completely private. It's owned by the state. So the key question here is, and everything shows up in the results. The minority shareholders say that the value of cash on the balance sheet of their own public listed firm is not worth it. It's not worth $1. It's worth much less than $1. That's the key takeaway. It's not that I'm being protected. It's nothing to do with the fact that, yes, the other benefits are. I'm not getting any of it as a private, as a shareholder in the public listed firm.
Raman?
Two questions. One, is there an ability to understand that as the minority shareholders, you could have two different situations. One where, the transfer by that subsidiary company to the parent is fatal in the sense the company sort of, completely winds down operations in a, some finite period of time. Yeah, the subsidiary. So, the point is well taken that yes, the parents have incentives to take away money from the subsidiary, but what is the effect of that? Is it something which is, completely value destroying, as, Rick correctly pointed out, or is it that, business does go on and this is something which is part of business and there is, at some point of time, some even return of that money? So, is there an ability to differentiate between these two situations?
Let me put it this way. There are no cases where the subsidiary goes bankrupt, right? So there's nothing fatal happens to the subsidiary. All we are showing is that in the case of intra-group loans, the market seems to believe that over 90% of those loans are never going to be returned. In the case of cash, it's not worth more than 50 cents for every dollar you make. So that's what we're saying. So that's where the value destruction is coming in. And the value destruction may be compensated by value creation at the parent. But as a shareholder of the subsidiary, what does it matter to me what's being created up there? I'm not seeing it. Right? If I did expect that money to come back, the value would be higher.
And just another thought. I mean, is it possible to sort of transplant this scenario into the Indian government context, where you have the government happily taking money from its state-owned enterprises, and it continuously happens? I mean, there are huge payments that are made for purposes of government's borrowing costs and subsidies. Would that be applicable?
And we in the paper do argue that it's applicable to all countries where it shows a significant role for the government. So you should, if that data is available, I suspect this is exactly.
No, because it's a strange thing. I mean, we had a change in government, and the entire world and country believes that it's a better government. The PSU index actually went up something like 50% over a period of less than a year when the sort of before elections and then post elections. So it does sort of go down to your point that the country and the shareholders believe that because the parent is doing better, the value of that same firm has done better. I mean,
So we have time for, okay, 4 more questions. So Vidhu, Ajay, sorry, Vidhu first, Ajay, then there, and last question Abhinav, and then I give the floor to Raghu to wrap it all up.
After that.
Okay,
I'm sorry. I mean, no, Anjali, you guys do it on later. Sorry.
Raghu,
We are running out of time.
It's my turn, yeah. So in your data set, is there a wide variety of, wide variation in the amount of control, that is the minority shareholder interest versus the controlling shareholder interest? Are there companies with very little, which is like almost 90% is controlling shareholders versus the ones which are 51% or 60%?
Good question. We do control for that in the regression. It's a variable in the regression, but there is a variation.
And does that impact anything?
Not really.
That doesn't impact
Not
anything?
really. The moment you're controlling, you're controlling. It
Okay.
doesn't matter that you're controlling with 51% or 90%. No.
Okay.
Okay. Ajay?
I really like the question. I absolutely like this concept of worrying about the value of cash, and it's a great organizing principle to think about these things. I just have a whole bunch of methodological concerns. These regressions involving corporate accounting data are riddled with problems. There are huge difficulties with outliers in most firm data, and I would really worry about conventional OLS versus a little more robustification.
We
Winsterize,
huh?
Winsterization is not an adequate scheme.
Yeah.
Okay, so you have X and Y, you knock off the tails of X, you knock off the tails of Y, but there are weirdo observations who are away from the line, and they just ruin the regression. So corporate financial work using accounting data is just a nightmare because of data problems and econometrics problems. I could tell you endogeneity stories about many of these regressions. It would be much nicer to have some clear exogenous variation, some matching type strategy. So just, can we do some 21st century econometrics? The basic question, the basic setting is great, but this is like so 60s in terms of the work.
Yeah. Fair enough.
I am VV Anand, formerly of SBI.
So
Right,
I'll
Raghvendra.
have to request that we are slightly running out of time. So
Just
short-
one point.
Short would be good.
Do these loans carry interest? If the interest is being charged and if it is being serviced, then there is no need to value something at 5 cents.
Can you repeat that? I'm not quite sure.
If the loans carry interest and the interest is being paid, and if it's a fair market rate of interest,
It
then
is
there's
not.
no need to.
It is not. It's an intra-group loan with no interest.
Abhinav, last question.
Do you want to have you accounted for dividends? Like in
Yeah.
China, the dividend tax is pretty high. So
They're control variables in our regression.
okay. Nature of the subsidiary, is it's the subsidiary also a state-owned enterprise, or will it be
Publicly listed firm.
no publicly listed? But
The state may own shares in it, but it is not a dominant.
maybe you want to throw a control variable showing that whether the firm at certain point was owned by the state or never owned
Has
by
been spun off, you mean?
Yeah.
Not in our sample period. If it was spun off before 1999.
and maybe you want to
Abhinav, I have a special request, and as a host country, I have to accede to it. Chung Young has a question.
Doing the loans between the private firms, and he finds that it has a lower return for the firm as well. Basically, his argument is because actually this cash holding means that there is a lower return on the investment than that they hold the cash, so they don't have good projects. So that explains the lower return.
Wait, the subsidiary doesn't have it, or the parent doesn't have it?
There is no subsidiary or parent. It's just two firms make loans to each other.
Okay, but we're not looking at that. We don't have any of that in our sample. It's just parent, subsidiary, right? We're looking at only pairs.
Yeah.
So, and every firm is either a parent or a subsidiary in our regressions. We don't have any cases when there are two firms that are not parent subsidiary.
And as soon as they make loans, they got
You can make
lower
loans to other
returns.
firms. You're absolutely right. You can make loans to other firms, but they won't be in our sample if you don't own the other firm, because that's not our research question.
So
Okay,
can I
So we'll
cut
pick
in?
that up.
And Raghu, you've got the floor for 30 seconds.
I don't need it. I
Okay,
can
fine,
open it
great.
up for one more question if necessary.
No, you don't have the time. I'm stealing time. So thank you very much.
All right. Thank you.